You're listening to Change Your POV Podcast, episode 71.
It minimizes fees and it removes emotion from the equation. So the big problem in the investing world is people invest on emotion. The whole world knows buy low and sell high, but nobody does it. So the market's going up every single day, people get euphoric and that's when they buy, but they end up buying high. And then when the market crashes, they panic and sell and move all their money to cash.
Welcome to Change Your POV Podcast, helping you navigate transitions in your life like entering and exiting college or the military, changing jobs or careers, and providing you with the coaching and mentorship needed to help you advance in your personal or professional life. Sometimes all you need is to change your point of view. Now, here's your host, Eddie Lazary.
Hello, folks, and welcome to Change Your POV Podcast. Today, we sit down with Nick Bradfield. Nick is a Marine veteran that graduated from Northwestern University with a master's in predictive analytics. He started his career in financial services as a financial advisor with a large brokerage firm. Through this experience, he found an interest in helping people minimize fees via index funds, ETFs, and so on. The idea for DIVVY Investments was born. After a few years, Nick decided it was time to move on. He spent a while in a financial services consulting firm, followed by a brief stint at a publicly traded technology company. Nick was not the right fit for that corporate world. Upon being told he needed to care less about his customers, he decided it was time to go into business for himself. So what is DIVVY Investments? DIVVY Investments, LLC is an online subscription-based tool designed to simplify retirement investing. All right, now let's hop right into this interview with Nick, already in progress. We're more sober veterans. That's how it is. We're more sober. All right, folks, welcome to Change Your POV Podcast. I am your host, Eddie Lazary.
And I'm Bennett Tanton.
And today we have the pleasure of sitting down with the owner and creator of DIVVY Investments, Mr. Nick Bradfield. How you doing, sir?
Outstanding as always. If I was any better, there'd be two of me.
That's awesome. So I had an opportunity of listening to your episode on Cigars and Sea Stories, but for the benefit of the folks, the listeners of Change Your POV Podcast and may not have caught that episode, why don't you take a moment and share with us and the listeners a little bit about you and where you're from?
Sounds good. I grew up in Iowa, joined the Corps after high school. I was basically the easiest recruit they ever had. I walked in and said, hey, I want to go in the infantry and I want to leave in 2 weeks or I'm walking out the door. And they, of course, said, well, you should take the ASVAB and see what you qualify for and da-da-da-da. And I said, I want to go in the infantry. I want to leave in 2 weeks or I'm walking out the door. And they replied, sign here. And and away we went. So I went to school infantry, boot camp and school infantry, ended up in 1st LAR. Bennett, you have a peace offering coming your way for that.
And I don't know if I've actually talked about that story on Change Your POV.
No, I don't think so.
But I'll make it real quick. Okay. All right. So as most of you know, I am a reconnaissance Marine, but I was in second Recon Battalion, which in 1994, if I'm not mistaken, 1994, we did a change of command ceremony where we gave up our reconnaissance battalion colors to 2nd Light Armored Infantry Battalion, which then in turn became 2nd Light Armored Reconnaissance Battalion, and we became 2nd Reconnaissance Company attached to Headquarters Company or Headquarters Battalion, 2nd Marine Division. And a lot of people were quite bitter about that I being one of them. And so since that point, and me going on and on about that on broadcasts on Cigars and Sea Stories and whatnot, Nick has, being an LAR guy himself, has offered the peace offering, and I have accepted, and put aside the differences, and it's all kind of a big funny joke, but yeah.
So it sounds like, Bennett, it sounds like to me, your unit was essentially castrated and given a stepfather.
Correct.
Okay, got it.
That's pretty much it.
Yes.
So
An
as
absentee stepfather at that. So
yeah, okay.
So I heard this and couldn't really stomach the sound of another Marine just whimpering. So, so I was like, I got to do something for this guy. I got to extend the olive branch. So I am sending him a first LAR challenge coin as a peace offering, and we will make him an honorary member of First LAR.
That's awesome.
it is.
Well, the question, Bennett, becomes, will that in fact stop the whimpering?
Oh yeah. Well,
okay.
Maybe not, because I'm not as bitter yet. And I see I've moved on. I guess I have. I'm more bitter about the whole part about me losing all of my Marine Corps stuff. That's what I'm really bitter about. But we can go into
specifically mentioned the challenge coins.
Yes, the challenge coins that I lost. Lots and lots of them.
Well, I'm replacing it with a damn good one.
That's awesome. So when you're at the bar, Bennett, and somebody slaps down a challenge coin, do you really pull out that excuse about the ex-wife?
No.
Or do you just be like, oh damn?
No,
dude,
usually I pull out my like General Shinseki, like the best coin I have now is he was the Army Chief of Staff. It's a pretty, he's part of the Joint Chiefs. It was a pretty heavy duty coin. You know what I mean?
How did you not lose that one?
Because that one was from the Army, not the Marine Corps.
Oh, you kept all your Army stuff.
The
Army
things you really cared about, you kept safe.
That was post that.
I need to stop the mail.
That was post that relationship. So.
Well, we actually did an episode, Nick. I'm not sure if you're familiar with it. When Bennett first came on Change Your POV, one of our first episodes was actually titled "A Marine Wearing an Army Uniform."
I do remember that. Yeah.
And I don't identify as a soldier ever.
Right.
You know what I do identify though as a member of the 10th Mountain Division. Not the Army. So
right. That's true.
And I can introduce you to a few other Marines that were the same way. We just happened to be Marines that were in the Army.
So meant just real quick, talking about all the pissing and moaning. Have you guys been keeping track about this stupid sleeves being rolled? Rolling the sleeves.
See, in the Marines, it's easy. It was always, sleeves up, sleeves down. In the winter, sleeves were down, and in the summer, sleeves were up. Sun's out, guns out. That's it. You know what I'm saying? And in the Army, there was always this weird thing, Fort Drum, that's where I was in the Army, and we always had our sleeves down because it's always like 6 degrees there. But this whole it's such a shit show. But anyway.
All right, enough tomfoolery. Welcome to the show.
Thank you.
And Bennett did not forget to mention that I am outnumbered on this show tonight. So I will keep that in the back. So we're surrounded by 1.5 Marines, and one full-fledged Army guy. Okay, so I got a whole bunch of questions here, and I know that you're very astute at your job in investing, and so a lot of these questions, to be honest with you, are a little self-serving on my behalf, because these are some questions that I have.
Tell us about DIVVY Investing first.
Yeah,
okay.
Let's do that.
So I'll give you the Reader's Digest version. Got out of the Marines, went to college. Then 2008, the world was falling apart. Being a Marine, you see smoke, you run towards it. So that's when I jumped into the financial services industry. I was a traditional advisor, with a large brokerage firm, and did that for a couple years. And that's really when I came up with the idea for DIVVY. But I had a non-compete, so I couldn't do it then, even though the reality is they probably wouldn't have come after me, but I didn't want to be the one guy that they did. And they're like, you owe us $1 million. And I'd be like, I don't have it. So I went into the corporate world for a few years while I was waiting for the non-compete to go out. And finally someone said, we need you to care less about customers. And I was like, I can't do that. I quit, came home, told my wife. She is amazing and didn't completely freak out and kick me out when I said that. And she said, well, you've been talking about this business for a long time. You either do it or don't. And I said, well, you can't tell me stuff like that because I'll actually do it. And so the next day I started DIVVY Investments. It's algorithm-based tool. It's online. It's subscription-based. It's about $1 a day. My goal is to simplify investing as much as possible. The industry as a whole does a really good job of confusing everybody. They do that to play to their advantage so they can charge a lot more and everybody gets confused. What my tool does, it simplifies everything. There's 5 models. They're all filled with index funds and ETFs, so they're all really low cost. And you fill out a risk tolerance questionnaire. It spits out a model, an investment model with specific investments in it that you should invest in. I don't hold funds or link to any accounts. You then take those recommendations and apply them wherever you hold your money, whether it's 401k, IRA, brokerage firm, Fidelity, Vanguard, wherever. Then I monitor the models, or the algorithm monitors the models, and as soon as they get out of balance, it sends you an alert that says it's time to rebalance. So what that does for you is it gives you control, it minimizes fees, and it removes emotion from the equation. So a big problem in the investing world is people invest on emotion. The whole world knows buy low and sell high, but nobody does it. When the market's going up every single day, people get euphoric, and that's when they buy, but they end up buying high. And then when the market crashes, they panic and sell and move all their money to cash. And that is a very poor long-term plan, but that's what many people do because it's so hard to remove that emotional piece of it. So that's the goal of DIVVY Investments, and that's it in a nutshell.
Okay, so I'm going to ask a lot of questions that are going to come from the perspective of the novice, because that's what I am. I'm an extreme novice, and I don't know about you, Bennett, but I know that a lot of our audience probably falls in the same category I do, and that's okay. And that's the reason why we wanted to bring you on, Nick, is so you can kind of help us novices kind of navigate this world of investments and kind of help clear that up. But before I get into those questions, I wanted to briefly go back and talk about the company that you worked for when they basically told you that they wanted you to care less about the customers. What was it that they were focusing on? Was it just the margin in increasing their revenue, or I mean, what was it that they were asking you to do essentially?
It was a very transactional company. So the when I started there, I had some success from some strategic selling and really focusing on consultative selling. It wasn't an investment company. I spent some time in a financial services consulting company and then in a technology company. But our division was very profitable, but the company as a whole was just hemorrhaging money. So they were relying on every dollar from our division. So they kind of removed the focus of strategic, bigger picture sales, and we're really just started to focus on, hey, we need as many transactions as possible this month, which is yucky.
Yeah,
it's just
it's just awful. What were most of those transactions like online transactions through like application APIs and things of that nature? Or were they like more of the brick and mortar like investment brokers that people would go and see?
So that particular company I was at was on the technology end, so it was IT stuff towards the end.
Got it.
Yeah.
Okay. So that's interesting. Now, really quick, DIVVY, that's DIVVY, correct?
Correct.
And what does that stand for? Is that an acronym or what is that?
That came about, you guys probably know this from being entrepreneurs as well. One of the funnest things you do as an entrepreneur, which you quickly realize means absolutely nothing, is it's a lot of fun coming up with a name. So,
yes.
And you're like, this is so awesome. And then you realize nobody really cares what the name is. But my wife and I think we were literally Googling 2-syllable words that sound cool. And I don't know if Divvy sounds cool, but that's one of them that came up. So as we were scrolling through them, divvy meant to allocate, or to divvy up, or to allocate. And we were like, oh, that's pretty cool, because that's what the whole business is about. And then as that got on the short list, we realized that Divvy had a DIY and we're catering to the do-it-yourself investor. So we were like, oh, wow, this is an easy decision. Let's go with Divvy.
Yeah, that's cool. Exactly what I thought whenever I heard it. So
yeah, me too.
Mission accomplished, sir.
All right.
Yeah, good job. Nice name for the company. That's awesome.
Thank you.
So what year did you start?
That's a little bit loaded. So I came up with the idea when I was with the big brokerage firm I was with them from 2008 to 2011, and I probably came up with the idea in 2009, but I started the company in 2015. So I started it, actually, kind of funny. So I quit my job on March 31st, 2015, and I started Divvy on April 1st. So I think my wife kind of thought I was kidding when I said I started a company, but like I was going to play an April Fool's joke or something. But a year and a half later, still going.
So how was your experience with Bunker Labs?
Awesome. I can't say enough good things about Bunker Labs. For me, it was I had participated in a couple of other accelerator, incubator type programs, and they were good, and I got a lot out of those as well. I'm a glass half full kind of guy to begin with, but the Bunker, the best thing about it was right off the bat, there was automatically this trust in the room. So we just set all the bullshit aside, and there was automatically this trust, and everybody in the room was collaborating in some way by the end of the cohort. And it was awesome. And for me, it was a way to, there's this massive veteran network. You have no idea how to tap into it. The Bunker is how you do it. And
especially for veteran entrepreneurs.
Yeah, absolutely. So the beauty of it is there's 10 of them across the country. So
and more every day.
Yeah, and it's only going to get bigger. So I went up to DC and was able to participate in some things for Divvy up there. And when I did, I got to tap into the Bunker in DC, and I didn't know any of those guys. And I just walked in, said, hey, I'm with the Bunker down in Raleigh. And it was like I had been in a unit with these guys. They were just like, yeah, hey, here's what we do. I did the same thing in Chicago. I did the same thing in Austin, Texas. It's how you tap the veteran network.
And for those that don't know, Bunker Labs is it's a veteran, it's an entrepreneurial accelerator, but it's specifically for veteran entrepreneurs.
Yep.
Is basically what it is. Yeah, it's a pretty awesome place.
So what services do they, but not to go down the Bunker Labs road. I mean, we're here now, so let's just briefly cover it for the listeners.
Yeah.
What type of services do they provide? Is it funding? Is it education? Is it angel investing? Is it what is it exactly that they provide veteran entrepreneurs?
So they don't actually make an investment. They provide a lot of education. They give you access to investors, but the Bunker Labs itself does not make an investment. So the goal is, and each of them is run a little bit differently, but kind of with the same overarching goals to educate, inspire, and connect. So they have, at least our cohort, on one day we would have classes. And so I think ours was 16 weeks. It may be 12 now, but over the course of the cohort, every Tuesday we would have classes, and the goal would be to take you from idea to up and running, outselling during that time. And so they would walk you through each phase of that, the business plan, marketing, legal stuff. And we'd always have speakers come in and most of them were veteran entrepreneurs as well, who had been successful and were experts in their field. And they would come in and we'd get access to these people and just get to pick their brains for a little bit. And then we'd have another day where they called it a brain trust, where people from all around the community would come in, and this one would be open to the public. The other one, the class time, would just be us. But the one that was open to the public, they would come in and help us work through whatever issues we're working through. So we'd pair up with a couple people in the audience. We'd go through, kind of talk about different situations. A couple people would present. You'd get an opportunity to practice your pitch and get feedback, whether you're pitching for customers or to investors or whatever. You could get feedback in a safe zone. And it was you get a ton of access to connections that if you tried to cold call into, you're not going to get as far as you would by just having somebody walk up and introduce you at all these bunker events.
Right.
Yeah. So what was the prerequisite for DIVVY Investments to enter this cohort?
Awesomeness.
Nice.
I think it had, I think that's a little fluid. You had to be a veteran-owned business, something scalable that they could help you scale and grow. But at all stages. I mean, there were people who were in the idea stage. When I got in it, I was already up and running, but still there were some things that I missed and fine-tuned and went back and kind of redid a little bit. So the two main things are veteran-owned business and something scalable.
And something that's kind of past proof of concept, so that, that's definitely a viable business, if not already, that can be.
Right.
Yeah, kind of like the Shark Tank. They want people that already have a backlog, already have a customer base, already have sales on the books, that kind of a thing.
Yeah, like
right?
You basically have to have it, and not up and running necessarily, but the business plan, the where you getting money, where a lot of that type of stuff. So
got it. All right, cool. So we're getting back into investments. Nick, what were some mistakes early on that you made as an investor, as an early or new investor?
The same thing that a lot of people do. I mean, I have since learned from it, but thinking that you're the smartest stock picker in the world and that you can beat the market, and you just can't. If you do, you're lucky. That's it. I played around with some stocks before I became an advisor, and you just kind of get lucky. If you're, unless you're doing the Warren Buffett style where you're gonna buy and hold them forever, and you buy a good company that's run well with good financials and you're gonna hold it forever, that's different. But the thing people do way too often is they're like, oh, I think it's a good time to buy whatever XYZ company because of this, and this, and then I'm gonna sell it right after the Olympics, and that's just, you're guessing.
Yeah, and they end up making like $2,000 on their entire transaction.
Right,
and then they think they're ahead. Right, and then they think they're ahead of the game.
Right. And that problem was actually, that was fueled so much after the crash, because there was this huge run in the market after the crash in 08 and 09, where the market was skyrocketing every day, and a monkey could be a great stock picker then, because everything was going up, so it didn't matter. So all these people just jumped into this day trading thing.
Yeah.
And I mean, it sounds so cool and it's so sexy to be like visualize yourself moving millions of dollars in and out of these different stocks, and that's so cool. And then you get on your private jet and go to Hawaii. Well, that's like one person in the world, so
right.
Yeah, what's that movie with Leonardo DiCaprio?
Wolf of Wall Street, yeah.
The Wolf of, right? Everybody watches that movie and they think, "Oh, that's what being an investor is all about," right?
Yeah, it's just that's the common thing is thinking that you can beat the market, and you just can't.
So do you notice that a common mistake that a lot of people starting out make?
Absolutely. So a lot of people, because doing what I do or investing in index funds or something like that is so boring, and it's not sexy at all.
Right.
I mean, I make it look sexy, don't get me wrong, but
What do you trade in your skivvies?
yeah, that's right. In my silkies.
In your silkies? Hell yeah.
Silkies on Facebook Live.
That's right.
Hell yeah.
That's
Absolutely.
right. I'm buying the S&P 500 right now.
Watch
Boom.
this, bitches.
So folks, if you're out there and all of a sudden you see DIVVY Investments coming live on Facebook Live, tune in, because you never know what you might actually see.
Yeah. So that is, I mean, that's what people do wrong is they'll start out investing and they're like, hey, I'm going to invest for the first time and I'm going to buy, name the company, it doesn't matter, this stock. What do you think about that? And I'm like, I think it's a bad idea. And they're like, what are you talking about? This is a great company, great stock. I'm like, yeah, it is. You're going to have all your money in one company. I don't care what the company is. That's a bad idea.
Yeah.
So stocks are much sexier than like index funds and mutual funds. But unless you have enough money to buy at least 20 different companies across a variety of industries, you shouldn't have any stocks for your retirement money.
Right.
I mean, you might have a E-Trade or Scottrade account where you are doing that. You're just kind of playing and seeing what happens. That's kind of fun. But like your real money, your retirement money, it's in your 401k or IRA, unless you are able to diversify effectively through a variety of industries across a variety of companies, then it's just not really a good idea mostly.
Yeah, quick story about that on showing how detrimental it can be to put all your eggs in one basket is when I was working for the company that I worked for before, the big nuclear company that I worked for. This is in 2000. I started with them in 2003, and then on our way up to the crash in 2008, I had a guy that I knew who was nearing retirement. He was actually going to retire, and at the end of 2008 had close to $1 million in his 401k, in his retirement account, right? Along with his actual pension and whatnot, right? Well, here comes the crash, and he had something like 90% of his 401k in our company stock.
Yep.
Which was, at the time, it had been a phenomenal stock. It had done nothing but climb and climb and climb. Then we split. It moved up again and was somewhere in the 100, trading at somewhere around $90 a share. Okay. And it went in the matter of about 36 hours. It went from 90 to around 22 or 23.
Yep.
Because the prime, all their money had been tied up, and their main investor was Lehman Brothers. So he lost about $750,000.
Yep.
And almost committed suicide, the whole thing. It was horrible. It was horrible.
Oh my God.
Now, needless to say, he wasn't able to retire. But within a few years, he actually had the majority of his money back. But it just shows, don't ever put all your eggs in one basket. And the one thing that, and I'm sure, Nick, you would agree, that mutual funds and funds in general allow you to do is spread your, without too much finagling, and like you said, instead of owning individual stock in 20 different companies, the mutual fund kind of does that for you. So it spreads your risk across many investments. I mean, sometimes thousands of investments, depending on the fund.
So, question on the mutual fund that you're referring to. So, how does that work? You put in money, and it goes across like companies that you select, or that are automatically selected, or do you, as the investor, choose which companies that are used in the mutual fund? Like, how does that work?
That's a good question. So a mutual fund is like a basket full of a whole bunch of different stocks, and there are thousands and thousands of mutual funds out there, and to go along with about every investment philosophy you can think of. But you don't pick the stocks that go in that mutual fund. The beauty of a mutual fund is, say you don't have, say there's 20 stocks you want, and you're looking at buying 100 shares of each, and they each cost $100 a share. Well, that's a lot of money you need to put up to get those 20 stocks. Whereas a mutual fund might cost the same as one of those stocks. And so you get diversified across a whole bunch of different stocks for significantly less money to buy into. So you're not, when you buy a stock, you're buying an ownership stake in that company. Mm-hmm. When you're buying a mutual fund, you're getting a piece of that stock. So you don't have voting rights or anything like that with it. But a mutual fund, not to get too complicated, is really just a basket of a whole bunch of stocks, and you pay a management fee or an expense ratio is how it's worded, somewhere between 1% and 2%. And that's so some portfolio manager with a mutual fund company is managing that basket of stocks. They're looking at the goal of that particular mutual fund, and they're constantly looking at the markets and the economy and interest rates and all this stuff, and moving large amounts of money in and out of different positions within the mutual fund.
They're basically doing all the work for you.
They're doing it for you. Yeah.
So is that 1% to 2%? Basically, it's 1% or 2%, profit that the mutual fund company is making off of your business, basically.
Right.
Is that accrued is it like a flat fee annual, or is it based off of the return on your investment? Like, how is that determined?
So you actually never see it. It just comes out of the fund. It comes out of the money that you put in, that's a great question because a lot of people aren't aware of that. Another fun fact, which it's almost like you teed this up for me, and I'll spare you the hour-long tangent that I go on when I talk about this. But so there's these mutual funds, which are a basket of stocks and a way for people to get diversified across a whole bunch of different industries and stocks and all that. And the internal expense ratio is between 1% and 2%, and all mutual funds compare themselves to a benchmark, or what is often referred to as an index fund. Like, a lot of times people have heard of the S&P 500. That's an index. It's so you can buy an index fund which isn't actively managed, so there aren't portfolio managers constantly analyzing all that stuff and moving in and out of positions. They're just tracking this index, like the S&P 500. So they just have those 500 stocks in it, if they're tracking that particular one. Well, the beauty of an index fund is they cost a fraction of what a mutual fund costs.
Yes.
So they'll cost like 0.2% instead of 1% to 2%. So, some are even less. Some are a little more, but either way, it's significantly less, a fraction of what you'd pay in a mutual fund. But wait, there's more. Most mutual funds do not beat the index that they track in a given year. And if you look out year in and year out, the number of mutual funds that actually beat the index that they track year in and year out is a fraction of a fraction of a fraction of a percent. It is so small. So your question is, why would you pay more
for a mutual fund
for underperforming funds? And the answer is, I have no idea.
So is your recommendation to pay to do the index funds versus the
In
Just the straight up mutual funds, or
in most cases, I mean, you can't say a blanket statement, but in general, it makes more sense to go with an index fund than a mutual fund. Now, in some places, you might not have access to it. You might not. Most of the time, you do, but maybe in your company's 401k, they don't have index funds or something. It's just something to be mindful of. Be aware of what that expense ratio is. So all you do is you click on whatever the fund is, and it'll somewhere in the documentation for it, it'll say, it might say management fee, but more than likely it'll say expense ratio, and you want to see what that number is, and you want the lower the better.
Like I have an index. I have a S&P 500 index fund, and my expense ratio is like 0.15%.
Yep.
now does that fluctuate or is that set?
No, it's pretty set. I mean, I think the highest it's ever been is like 0.18 or something like that. But I mean, at 0.15, 0.18, I'm not going to scoff. Considering what I got into that from was a mutual fund that I was paying almost 2% on. And
if
it's
you
like,
think about, sorry, go ahead.
and I was paying brokerage fees on top of that.
Yeah.
So
if you think about, a lot of times people will be like, oh, it's 1%. What the difference is 1%. Who cares? It's not a big deal. Well, I mean, if you compound that over 20 years, that's a lot of money. Mm-hmm. So if you're able to, I'm definitely a big fan of index funds, and a lot of times you won't hear that mutual funds don't beat them because it's a massive money machine, and that's I mean
yeah, it is. It's huge.
Silly amounts of money pour in and out.
Trillions of dollars.
Yeah.
It's craziness. So entrepreneurs that are just starting out and have very little expendable income, would you recommend still investing? And if so, in what?
That's a tough question. I think that's a really tough question. I think.
Well, that's what we're here for.
If they're an entrepreneur, they're making a bet on themselves. So it's a delicate balance between investing in themselves, investing in their business to get it up and off the ground, and rocket ship growth. So I get that. At the same time, there are a lot of entrepreneurs who are either entrepreneurs on the side or are able to do some other job on the side, to kind of help get some cash coming in at first. And if you have access, if you're doing something like that where you have access to a 401k or you're able to put money in an IRA, it's so tricky because I get it. but
this is part of the reason that we're bringing you on, and I would like to continue this down the road where we bring you on every once in a while to talk about stuff, because it's freaking confusing, man, and it's set up that way on purpose.
Yeah.
Well, that's the thing too, is I'm looking at the time, right? And according to my time, I don't know exactly what time we hopped on, but we're almost at, we're past
10 minutes left.
We got about 10 minutes left, and I think I've asked 2 questions on my long list of questions, and I don't feel bad about that because Bennett's right. This isn't something that you can just cover in one episode. I mean, it's pretty extensive, and to really give it its full due, right? And to really, present all of the pros and the cons and do's and don'ts, and to answer a lot of these questions, it takes time to kind of really peel back the onion, so to speak, and get a lot of this stuff.
Some of them are pretty complex questions with very complex answers because they're so individualized.
Right.
That it's hard to give an answer.
Right.
So
I think maybe the different approach, Bennett, would be I know it's kind of almost a counterintuitive approach to what we normally do, but perhaps, I mean, Nick knows investments obviously a lot better than the both of us, and perhaps we're asking shotgun questions that are kind of all over the map. Maybe we can just say, let's put on the books like 3 or 4 future episodes, and then Nick, have you come up with 4, 5, 6 questions on each episode
that you think would be the most helpful.
is starting from A and working our way through to Z. You know what I mean? So that way, it's kind of a chronological progression of
Yep.
questions and answers as we go from episode to episode. Because at the end of the day, these podcasts episodes they live eternally in infamy, right? And this would be a great resource to be able to refer to people that are just starting out and say, all right, listen, you need to listen to this series of podcasts, 69 through 74 or whatever, because they discuss in order kind of invest. Because I mean I'm extremely interested in this stuff. Other than a 401k, Nick and Bennett, I have not invested in anything, and a lot of it isn't because I'm not interested in it. It's because I'm so confused. I don't know where to start. I don't know what to do. I don't know who to go to. I don't know if what they're telling me is bullshit or you know what I mean? It's such an unknown thing to me. It just scares the hell out of me. And so I just don't even go down that road. And I think a lot of people would if they were just more knowledgeable and had a little bit more confidence in what they were doing, I think they would actually invest a lot more than they either are now, or they would start investing going from nothing like me.
Yeah.
Well,
Go ahead.
I know a guy who can help you. So I would be happy to do that. I don't know if it would be more effective for me to come up with topics and kind of do an investing 101. I did a little bit of that on YouTube.
Yeah.
I did like 5 or 6 short little 3-minute videos that kind of talk about the very basics, like 101. And then each month I'm going to add a few more topics on there so we can go along with that. Or if there are questions that your audience may have, I'd be happy to answer those as well.
Yeah, I think that we could kind of work it out. You know what I mean? If that's something that you're willing to do.
Absolutely.
But I think right now, what I'd like to hear is possibly some actionable steps that somebody's starting out to kind of like look at this stuff. Just something, 1 or 2 things that they could do between now and the next time that we talk.
Okay. So I would have a few. First of all, in full disclosure, here's my high pressure sales pitch to you guys and to your audience. Ready?
I'm ready.
Are you guys sitting down?
I'm baited. I am. I'm waiting.
I'm sitting down
onto my seat.
All right.
I'm in my silkies.
Ready?
So I'm all set. Yep.
Thanks for the visual. So here's my super high pressure sales pitch. I'd be happy to help you guys out however I can. If using DIVVY Investments is a good fit, I'd be honored. If not, that's cool too. Whew, that was tough.
Damn, I'm sweating. I can't make it.
Tighten the screws on you.
I really can't make a decision right now. I'll have to get back to you.
Yeah, I understand how you feel. A lot of your neighbors felt the same way. What they found was...
I'll be back. I'll be back. I have to go talk to my wife.
So the reason I say that is the first thing I thought of. I have some information on my website on DIVVYinvestments.com. It is definitely a work in progress. Under the support section in the bottom left, there's a little thing called Help Center. And one thing I'm trying to do there is not have a million articles, but some pretty standard topics.
Yeah.
And like I said, it's a work in progress. So I'm periodically going to be writing articles and putting them up on there. So that'll be kind of a holding place for topics. And if there's something that somebody wants to learn more about, send me an email. I would absolutely love to hear about it. So my website would be a place to start. I think step one is trying to educate yourself as much as possible on this stuff. And where you would start with that is magazines, books. I like Kiplinger's Personal Finance magazine. It's a pretty good read.
What's it called?
Kiplinger's, Kiplingers.
Okay.
So
That's a magazine, you said?
Kiplinger's Personal Finance. You can get the digital edition if you want as well, or it's in the grocery store. Money Magazine is a pretty good one.
I have a subscription. It's fantastic.
Yeah. So
Fantaxes.
Fantaxes. So both of those are real good as far as magazines, and the beauty of those is there's a lot of little nuggets. It's not like digesting a textbook.
It's mostly in plain English too, which is kind of cool about money.
Yep. And as far as a book, if you wanted a book to read, there's a book from a woman named Kathy Kristoff called Investing 101, and it kind of walks people down Investing 101, which is good. So as far as investing, that's the place to start. Before that, I would even say take a step back and get your personal finances in order. So you can't really invest until you know how much you can invest. And a lot of people don't like to hear the word budget. It's kind of like a diet. So, people go on these fad diets all the time, and they yo-yo back and forth, and, they lose the weight and then gain it, and they go back and forth. And so, but I view budgeting as the same way. Like, people think budgeting is a bad word, that it means they can't afford something, or they're financially in trouble, and that just is not the case.
That's really a mindset with money, though.
It is, but that needs to change.
Yeah.
So having a budget, all it means is you know where your money's going, and I think too often when people hear budget, they're like, I'm not spending anything the next 6 months. And like, oh my God, that's a terrible idea.
That's like a money fast, not a budget.
It's not going to work.
Right.
The only way you're going to change your results is to change your behavior. So take 1 month or 3 months, whatever you can do, and write down every single thing that you spend money on.
All right. So real quick, that's a good lead into this question. This is actually one of the questions that made the list to talk about tonight. And that is, what do you recommend for people that are looking for a good personal finance software to help them manage their personal finances? I mean, I've heard things from QuickBooks to, Peachtree. I've even heard of people that download like Excel documents online that they find to try to track this stuff. Like, what's like the simplest something that people can use or download
for like
or
a
even
budgeting
buy?
software? Is that what you're saying?
Yeah, exactly. Like a personal finance budgeting software where people can actually track, like you said. I mean, I'll be honest with you. I tried to write stuff down, and oh my God, I forget where I write it down, or I don't know. What do you use, or what do you recommend?
So I'm an incredibly complicated person, and I use a pen and paper.
Oh, it's a typical Marine answer, right?
Sorry, an ink stick and paper.
Nice.
So get a little notebook, for $2, or a Green Monster book or something that you used to carry around when you're in the military.
Monster, holy shit.
Get one of those, and for the next 30 days, write down every single thing you spend money on. Every single thing. And it's only worth doing if you're actually going to write everything down. Like, not counting that, 6-pack you just bought is dumb. That doesn't help. It's not for anybody else to see. It's only for you. So I think at a basic level, get a notebook, write it down.
I think that's a really good point. I don't want to cut you off. I think it's a really good point to say, take a month and write everything down that you spent. Because a lot of times I think people, they get all gung-ho, like you said, it's feast or famine. So they get all gung-ho and they try to write up a budget, but yet they don't have a clue on what they spent because they bought Dave Ramsey's book or they bought Tony Robbins's book on money. And then they're like, all right, well, here's our budget. We have electric bill, we have cable bill, we have this, that, and everything. But then Nick brings up a great point. Well, did you take that 6-pack that you bought on the way home yesterday into consideration? Because if you didn't, then that's, $6, depending on what kind of beer you're drinking. I'm not drinking $3 beer. So $6 on whatever 6-pack you just bought. You know what I'm saying?
Yeah. And the challenging part too, I know for me, because it would be tracking the household expenditure, right? So I would have to not only write down what I'm spending, but I would have to make sure that
people just hemorrhage money.
And the family would have to write it down.
They don't even get it. They don't even understand.
So there are tools you can use. I mean, so I like the ownership of pen and paper. Excel is also great because you can do some fancy things in there and see some trends. There are some tools. Mint.com is free. You can link your bank account and credit card stuff to it. Personalcapital.com will do the same thing. Those are hugely popular, and both of those are free. I'm not as big of a fan of them. I'm like the one guy in the finance industry who's not. For me, it's just a security thing. Security's great on them. They've got all this encryption and all that, but my comment is it's great until it's not. So, though they are available. I mean, if you're comfortable with that, I mean, Mint.com is owned by Intuit. Personal Capital is a big company as well. So, I mean, there's some validity to them. But you can link your accounts and they'll track everything for you.
So let me ask you this. I kind of like the challenge, the 30-day challenge. Wink, wink, Bennett.
Yeah.
That's our next 30-day challenge, right? I say we do it. Bennett and I doing right now. It's called a 30-day challenge where we ask each other questions on Facebook.
I've seen
it. And we oh, you have? Okay.
Did I give you the answer for today?
You did.
All right, good.
Yeah, you answered it actually on time.
I'm in half a fucking coma, so.
But so we're looking for our next 30-day challenge, and I think the finance one would be awesome. So before this episode airs live, perhaps the three of us, you, me, you, Nick, and Bennett, we can craft perhaps a simple working document that people can go to the Change Your POV show notes page for this episode and provide their email, and then they could download a free template basically that they can print out however many copies they need, and it's a nice, quick, kind of very convenient thing where people can just print out 10 copies or whatever they need to start off with and start using that to kind of track their 30-day expenditure as a kind of like a place to start. What do you guys think about that idea?
Sure.
Okay. All right, that would be great. I mean, that would be fantastic. I mean, because you're right. It's kind of pointless to talk about, the differences between...
when you don't even know what the hell you're spending.
Right. I mean, talking about day trading versus stuff. You know what I mean? Like, why even get into that conversation if folks don't even know what the hell they're spending their money on right now, right?
That's step one.
So that's step one. That's what we can call this episode. Introduction of Nick Bradfield of DIVVY Investments and, P.S. What the hell do you spend your money on? Step one. Nice. I like it. Well, man, I really do appreciate you coming on the show. I wish we had more time, but again, I really think that we can leverage each other, my audience and your knowledge, and hopefully drive some more people your direction to really get into this. And myself included, I just got to know a little bit more about what the hell it is I'm doing first. And it starts with knowing what I spend my money on. And man, thanks for, this has just been an awesome conversation.
Went by quite fast.
It did. I was just like, oh my God, we're already like over time. And we've covered a ton of information. I've got like 3 pages of notes right here. So thank you for that. I love editing and show notes, but no, it's all good. But man, I'm going to link everything that we talked about in the show notes for this episode. Thanks, Nick, for coming on. Where can listeners find you or find more about you and DIVVY Investments? Where can they go?
DIVVYinvestments.com, Facebook, DIVVY Investments, and
What about YouTube?
YouTube, DIVVY Investments, Twitter.
To your website?
Yes.
So people can go check out those videos, because I've watched them and it's good to
all
go.
of those they're all linked right from my website. So if you go to DIVVYinvestments.com, all the social media stuff is at the very bottom.
Beautiful.
Excellent. Very cool.
There's a support at DIVVYinvestments.com on the website that ultimately goes to me, but my email is nbradfield@DIVVYinvestments.com as well.
And he has a newsletter.
Nick. And I have a newsletter.
Yeah.
Ooh.
So Bennett tried to Shanghai me earlier and said he signed up.
Well, I just did. I signed up today, though.
Yeah. But when you told me that, you were like, oh, I signed up. And I was looking at MailChimp right then. And I was like, are you sure?
There's a delay. There's a delay on MailChimp. Just saying.
So what type of information do you kick out on your newsletter?
Lots of spam. No.
Nothing useful.
Just kidding.
No.
It's a monthly newsletter. We just try to have some relevant topic. In May, we talked about 529 plans, which are like college funds, saving for college. June was traveling and exchange rates and stuff like that. So in there we'll have some sort of timely topic, an update on any events that are coming up. We posted the videos in the newsletter, so the new videos for this month will come out in the newsletter. So
that's awesome,
and it's monthly, so it's not too much.
All right, folks. I hope you enjoyed this discussion with Nick Bradfield from DIVVY Investments. I know I did. And I've got a ton more questions headed his way, and I hope you do as well.
And don't miss out on what Bennett and I are doing for this month's challenge. It's called the 30-Day Well Fit Challenge. You can find more about that by heading over to changeyourpov.com/30-day well fit challenge, all one word. We've got a lot of, we're about almost a week now complete with our challenge. We've got a lot of people that have actually signed up to participate along with Bennett and I. You can go onto that page and there will be spot on there where you'll see our fat pictures, our starting pictures, our starting weight and BMI or body mass index, and then we've got daily journaling that we write out what we're doing. We include everything we're doing for exercise wise, and we've got our dietary plan and food that we eat, and we've got videos that we're posting out the Facebook page. So it's a lot of fun. Sore as hell, and I'm sure Bennett you are too. But yeah, man, come be a part of that. It's awesome. And all right, folks. Well, I hope you enjoyed this episode with Nick Bradfield as much as I did. Boy, there's just a lot to learn here, and I look forward to having him on the show again in the future. Until next time.
Thanks for listening to Change Your POV podcast with Eddie Lazary. Check out more content by going to changeyourpov.com. And remember, your ability and willingness to change your point of view will open doors of opportunity.